had a giant bet for us, and I was extremely confident in the outcome. We made $725 million, I think, on the funds in 2007.
What is Michael Burry up to? The Big Short investor is back on the news, and this time it's because he's revealed some interesting moves in his investment portfolio. Let's find out. Now, Burry is known for his bold bets and isn't afraid to shake things up, while he frequently buys and sells stocks, making it hard to pinpoint his exact thinking. His latest 13F filing offers some intriguing clues about his current strategy. So, what's going on with Michael Burry's portfolio? Michael Burry's latest 13F filing paints a picture of an active investor constantly reevaluating his holdings. The data revealed a significant shakeup, with Burry exiting positions in 14 companies. This isn't unusual for Burry, who is known for his willingness to adapt his strategy based on market conditions. Some of the notable exits include tech giants like Google and Amazon, companies that have been major holding for many investors in recent years. This shift doesn't necessarily indicate a negative outlook of these specific companies. Instead, it suggests Burry may have identified more attractive opportunities elsewhere. We can only speculate on his reasons for selling. But it could be anything from a change in the company's fundamentals to a belief that the stock price is no longer undervalued. At the same time, Burry isn't afraid to double down on existing positions he believes in. The filing shows he added to 11 companies already in his portfolio. This could indicate increased conviction in these companies' long-term prospects. It also suggests that Burry has found opportunities to buy more shares at what he perceives to be favorable prices. Finally, the filing reveals that Burry added 5 entirely new companies to his portfolio. This willingness to explore new opportunities highlights his active investment style. These new holdings could be early-stage companies with high growth potential, or established business in sectors Burry sees as undervalued. By looking at specific companies Burry has chosen to buy, we can gain further insights into his current investment thesis. One of the most intriguing aspects of Michael Burry's recent portfolio moves is a significant investment in the Sprott Physical Gold Trust. This suggests a potential shift in his strategy, with gold emerging as a key player. Let's look into why Burry might be placing his bets on this precious metal. Gold has a long and storied history as a safe haven asset. During periods of economic turmoil, political instability, or high inflation, investors often flock to gold as a way to preserve their wealth. Unlike currencies, which can be devalued by governments printing more money, gold has a finite supply. This inherent scarcity contributes to its value proposition as a hedge against inflation. We've witnessed this phenomenon play throughout history. During the Great Depression of the 1930s, the price of gold skyrocketed by over 400%. Similarly, the inflation period of the 1970s saw gold price soar, reaching at a peak of over $2,000 per ounce. More recently, the 2008 financial crisis triggered another significant increase in gold prices, as investors sought refuge from the collapsing housing market and global economic slowdown. Burry's gold purchase suggests he expects inflation to rise again, weakening currencies. Gold's value traditionally holds steady during economic uncertainty, making it a safe haven for investors in times of geopolitical tensions or supply chain disruptions. Will gold shine again? Only time will tell if Burry's bet on gold proves to be a winning strategy. However, his move highlights the potential role of gold as a hedge against various economic risks. Investors keeping a close eye on the market and economic indicators can make informed decisions about whether incorporating gold into their own portfolio might be a wise move. Michael Burry's decision to increase his holding in Chinese tech giants like Alibaba and JD.com has raised eyebrows. These companies have been grappling with slowdown in China's economic growth, leading to a decline in their stock prices. However, Burry's move suggests a contrarian view, potentially betting on a future rebound. Let us explore the rationale behind his strategy. China boasts the world's second largest economy with a population exceeding 1.4 billion. This translates to a vast consumer base, presenting a significant opportunity for tech companies. Alibaba and JD.com are dominant players in China's e-commerce landscape, controlling a large share of the online retail market. They offer a wide range of products and services, making them an integral part of the daily lives of many Chinese consumers. China's economic growth has slowed down in recent years. This, coupled with regulatory crackdowns on tech companies, has impacted the performance of Alibaba, JD.com, and other Chinese tech giants. This slowdown, along with a regulatory hammer blow from the government, has sent their stock prices tumbling. But for some investors like Michael Burry, this might just be a fire sale. These bargain basement prices could be a chance to jump on board with China's long-term story. Sure, the economy is hitting a rough patch, but China is still on the track to be a dominant economic force for years to come. Their massive middle class, which keeps growing, is a goldmine for potential consumers waiting to be tapped by tech companies. Plus, the Chinese government isn't shy about pouring money into cutting-edge technologies, which could further propel these tech giants forward. So, while there are bumps in the roads right now, Burry's bet might be that the fundamentals are still strong for the long-term play. With their stock prices down significantly, Alibaba and JD.com could be seen as undervalued by Burry. This could present a buying opportunity for investors with a long-term perspective. Burry might believe that once China's economy recovers, these companies' stock prices will rebound. amount, potentially generating substantial return for him. It's important to acknowledge the risks associated with Burry's investment. The future trajectory of China's economy remains uncertain, and future regulatory interventions could continue to impact tech companies. Additionally, geopolitical tensions between China and other countries could also pose challenges. By increasing his holdings in Chinese tech giants, Burry is making a significant investment in the future of China's tech sector. This strategy requires a long-term outlook, as it hinges on China's economic recovery and continued growth for its tech industry. Only time will tell if Burry's gamble pays off. While the 13th filing doesn't provide a direct look at Michael Burry's cash holdings, it reveals a telling detail: significant fluctuation in his total portfolio value. This suggests a willingness to move substantial sum of money in and out of the market. Let's see what this potential cash reserve might signify. Unlike some investors who maintain a more static asset allocation, Burry appears to be a dynamic player. He's comfortable adjusting his portfolio based on market conditions. He might sell off holdings he believes are no longer attractive and deploy capital elsewhere. This flexibility allows him to potentially capture opportunities that arise from market shifts. Burry's current portfolio reflects a relatively high cash position. This could be interpreted in a few ways. One possibility is that Burry simply hadn't found enough investment opportunities that meets his criteria. He might be waiting for stocks to become undervalued before deploying his capital. This cautious approach could be a result of a perceived lack of attractive opportunities in the current market. For comparison, let's revisit Burry's strategy during the housing market crash. Back then, he identified a significant opportunity and went all in a short position against subprime mortgages. This bold move required immense conviction and a strong belief in his analysis. The high cash position we see today suggests a different approach. Burry might be waiting for a similar compelling opportunity before making a major investment. Successful investors understand the importance of patience. They don't feel pressured to invest their money just because it's sitting in cash. Burry's sizable cash position could indicate he's waiting for a right pitch, a situation where he can invest with a high degree of confidence in a potentially undervalued asset. The current market environment is characterized by a certain degree of volatility. This might be leading Burry to be more selective with his investments. He might be waiting for a market correction or a specific stock price to reach a level he finds attractive before deploying his cash. While the specific reasons behind Burry's cash position remain unknown, it highlights the potential role of cash as a strategic tool in an investor's arsenal. A healthy cash reserve allows for flexibility and ability to act when right opportunity arises. Only time will tell how Burry chooses to utilize his cash reserves, but his past actions suggest he'll be waiting for the right moment to strike. 13F filings only offer a glimpse of the US portfolio. Burry might have a significant intervention in investments. It's crucial to understand the limitations of this data. Michael Burry's latest portfolio moves has sparked debate among financial analysts. Some sees his gold purchase as a shrewd hedge against potential inflation, pointing to historical trends when gold prices have risen during periods of economic instability. Data shows that during the 1970s, a decade marked by high inflation, gold prices skyrocketed by over 1,200%. Analysts who support this view believe Burry is anticipating a similar scenario and is positioning his portfolio accordingly. However, others express skepticism. They argue that the Federal Reserve is actively working to control inflation, and recent data suggests these efforts might be yielding results. For instance, a report by the Bureau of Labor Statistics shows that inflation in the United States cooled to 5.2% in June 2024, down from a peak of nearly 9% earlier this year. These analysts believe Burry's gold play might be an overreaction, and that other asset classes could offer better returns. Overall, Burry's investment strategy continues to generate discussion and debate, while only time will tell if his bets pay off. Thanks for joining us. If you enjoyed this breakdown, hit the like button and subscribe for more content like this.